If you're earning yield on stablecoins right now, I need you to watch this to the end. Not because there's some new opportunity, because something is being taken away, and the people taking it aren't hackers. They're not a market crash. It's a proposed law dropped in Washington this week that most of the people it affects directly haven't heard about yet. You're holding USDC, you're earning 4, maybe 5% a year, no stock picking, no timing the market, just holding, and the income shows up. That's not luck. That's a rational, practical decision in an environment where savings accounts pay almost nothing. And Washington just decided that decision needs to stop. Not because your yield is dangerous, not because you're doing anything wrong, but because traditional banks are losing deposits to stablecoins and they have enough lobbyists to turn their fear into your law. According to a study from the Independent Community Bankers of America, if stablecoins are allowed to keep paying yield, the banking industry could lose $1.3 trillion in deposits. 1.3 trillion? That's not a number they're willing to accept without a fight. And they are fighting right now in a closed-door meeting at the White House that you weren't invited into. But here's what almost every news story about this misses completely. There is one asset in this entire space that the OCC, the agency that just proposed this rule, cannot write a single line of regulation to effect, not because it's specially protected, but because it has nothing to regulate. No rewards program, no yield structure, no CEO to call, no office to audit, and paradoxically, every time Washington tightens the screws on stablecoins, that asset gets structurally stronger relative to everything else. Not because it changes, but because everything around it is getting squeezed. I'll explain exactly how that mechanism works and why it matters to anyone thinking about long-term financial resilience right after I walk you through what's actually happening in Washington this week. Stay with me, because the full picture is more interesting than the headline. On February 26, 2026, the Office of the Comptroller of the Currency released a proposed rulemaking targeting stablecoins. 2 things on the table. 1, restrictions on companies launching their own branded stablecoins through white label platforms. 2, the one that matters more, restrictions, possibly an outright ban on rewards tied to simply holding a stablecoin. That second point is the yield squeeze. If you hold USDC and earn yield on it, Washington wants that to stop. Right now, you're probably thinking, why does a bank regulator care about crypto rewards? That's exactly the right question. And the answer tells you who is actually driving this. That's what's being taken away. But the way it's being taken, through a law signed last year with a loophole nobody told you about, that's the part worth paying attention to. The traditional banking industry has spent months in front of Congress making one argument: deposit flight. The logic goes like this. If stablecoin platforms can offer 4 or 5% just for holding a dollar-pegged asset, people pull money out of bank accounts and park it in stablecoins instead. According to a study from the Independent Community Bankers of America, allowing yield on stablecoin holdings could drain $1.3 trillion in deposits from the banking system, cutting community bank lending capacity by $850 billion. $1.3 trillion? That's not a rounding error. That's why the banks aren't just complaining. They're organizing. And it's working. The banks aren't afraid of crypto, they're afraid of competition, and they have the infrastructure to do something about it. This isn't coming out of nowhere. There's a law already on the books that set this in motion, the Genius Act, signed by President Trump in July 2025, guiding and establishing national innovation for U.S. Stablecoins Act, a name clearly built backwards from the acronym. At the time, it was celebrated as a win for crypto, a clear legal framework finally, but it had a gap. The Genius Act prohibited stablecoin issuers, companies like Circle, which runs USDC, from paying you direct interest. Circle cannot pay you yield just for holding their coin. That's in the law. What the law didn't say, it didn't stop third-party platforms from offering rewards. So Coinbase, which doesn't issue USDC, just holds it for you, could still pay you for holding it on their platform. Same economic outcome. Different legal entity doing the paying. The banks saw that gap the moment the law passed. They have been pushing to close it ever since. The law left the door open. The banks walked through it immediately. And what happened next, inside a room at the White House, shows you exactly who's writing the rules for your money. On February 2nd, 2026, 3.5 weeks before the OCC proposal dropped, the White House hosted a closed-door meeting in the diplomatic reception room. Crypto on one side, Coinbase, Circle, Ripple, Andreessen Horowitz, the Blockchain Association, banking on the other, the American Bankers Association, the Independent Community Bankers of America, the Bank Policy Institute. Led by Patrick Witt, Trump's personal crypto advisor and executive director of the White House Crypto Council. The goal was a compromise on stablecoin rewards before the end of February. They left without one. What's emerging in the draft legislation circulating right now is a split the difference, ban passive yield. You cannot earn income just for sitting on a stablecoin, but allow activity-based rewards. Make transactions, provide liquidity, join a loyalty program. Then you can earn, just park it like a savings account. Nothing. For anyone currently earning 3 to 5% on USDC, that distinction is the difference between a strategy and a dead asset. No agreement, but the direction is clear. And once you see that direction, you understand why one asset with nothing to do with this fight is quietly becoming the most interesting beneficiary of every failed negotiation. Here's the part almost nobody is connecting. There is one asset in this entire space that the OCC cannot write this rule about. It has no issuer to regulate, no rewards program to restrict, no yield structure to ban, no CEO to call in for a hearing. Bitcoin doesn't pay yield. That's not a weakness. In this regulatory environment, that is the entire point. You cannot legislate away Bitcoin's interest payments because Bitcoin doesn't have interest payments. You cannot force Bitcoin to stop offering rewards because Bitcoin doesn't have a rewards program. The OCC can write 200 pages of proposed rulemaking about stablecoins, and not one line of it touches Bitcoin's fundamental value proposition. Because Bitcoin's value proposition isn't income, it's scarcity, decentralization, and the fact that no regulator can alter its rules. This is the regulatory dividend. Every time Washington tightens the screws on yield-bearing stablecoins, the comparative case for Bitcoin gets structurally cleaner. Not louder, cleaner, less regulated competition, less income-based alternative, one fewer reason to park capital somewhere else. For years, the pitch against Bitcoin went like this. Why hold something volatile when you can hold dollar-pegged USDC and earn 5%? That pitch worked. Billions flowed into stablecoin yield positions. The yield squeeze removes that pitch entirely. Now it's hold stablecoins and earn nothing, or hold Bitcoin, accept the volatility, and keep the one thing regulation can't touch. Some of that capital has to go somewhere. That's the mechanism. But the mechanism only holds its full weight once you see the geopolitical dimension behind it, because there's a country going in exactly the opposite direction from Washington right now, and that's creating a currency war most Americans don't know they're already in. Before we go further, I want to be straight with you about where Bitcoin actually stands right now, because the structural argument doesn't change the price chart. And the price chart is rough. As of late February 2026, Bitcoin is down roughly 27% year to date. It's sitting about 50% below its all-time high of around $126,000, which it reached in October 2025. The Fear and Greed Index earlier this week hit a reading of 5. Extreme fear, reportedly lower than the 2018 bear market, the COVID crash, and the 2022 crypto winter. Bitcoin did bounce. From a low near $62,500 on February 24th, it recovered more than 5% to around $67,500. Over $37 million in leveraged short positions got liquidated in 24 hours during that move. Battered, not broken, but the macro environment, tariffs, risk-off sentiment, genuine uncertainty about where rates are going is still a real headwind. None of that disappears because of a regulatory thesis. What the regulatory dividend does is not guarantee a price move. What it changes is the structural logic of the comparison. And for people making long-term allocation decisions, that matters more than the weekly chart. There's one more dimension to this that doesn't get nearly enough attention. China's central bank, the PBOC, began paying interest on digital yuan wallets starting January 1st, 2026. They're explicitly making their central bank digital currency more attractive through yield, more attractive domestically, more attractive for cross-border payments. China is going one direction. US regulation is going the opposite. Here's why that matters beyond crypto. Dollar-backed stablecoins, USDT, USDC, currently dominate global digital payments. They're not just a crypto thing. People in Argentina, in Nigeria, in Turkey, countries where local currency is being destroyed by inflation, are using USDT to hold their savings in dollars. This is genuine dollar adoption spreading through private crypto infrastructure. If US regulation makes dollar stablecoins less attractive, bans their yield, restricts their features, while China simultaneously makes the digital yuan more attractive by paying interest on it, that is not just a crypto story. That is a dollar dominance story. Coinbase's chief policy officer made this argument explicitly. If this issue is mishandled in Senate negotiations, it could hand global rivals a meaningful competitive advantage in digital payments. Bitcoin sits entirely outside this geopolitical currency war. It's not a dollar. It's not a yuan. It belongs to no government, which means no government's regulatory choices can make it less competitive relative to another government's currency. That borderlessness isn't a bug in the current environment. It's the product. This is the decoupling thesis. Not that Bitcoin disconnects from macro, it doesn't. But its regulatory surface area keeps shrinking relative to everything competing with it. And simplicity is increasingly what institutional capital requires before committing at scale. Now you have the full picture. The last piece is the most practical. What to actually watch for in the coming weeks, and what this means for decisions you might be facing right now. The OCC proposal now enters a public comment period. Coinbase, Circle, Ripple, and the Blockchain Association will file detailed objections. The banking lobby will support the restrictions. This process takes weeks to months. It doesn't resolve overnight. The larger Digital Asset Market Clarity Act still needs to clear the Senate Banking Committee. The stablecoin rewards fight is currently the single biggest roadblock. As of late February, prediction markets were pricing roughly even odds on the Clarity Act passing. That's essentially a coin flip. It tells you how genuinely uncertain this is. Watch for statements from three people specifically. Senator Angela Alsobrooks from Maryland, vocal on deposit flight concerns. Senator Tom Tillis wants an independent regulatory assessment. And Patrick Witt, the White House crypto advisor who's been leading the negotiations. When those three names show up in headlines together, something is about to move. Here's the honest read on the long game. Regulatory clarity, even when it's restrictive, is ultimately more useful for long-term investors than the gray zone. If the Clarity Act passes with Bitcoin formally classified as a commodity, that removes a significant legal overhang and opens the door for institutional capital that currently can't touch it because compliance teams won't approve an asset without a clear legal classification. Here's what to carry forward from this. The yield squeeze is real. The direction is clear even if the final form isn't settled yet. If you're currently earning passive income on USDC or any yield-bearing stablecoin through a US-regulated platform, plan for that income to disappear. Not panic. Not sell everything. Just plan. Activity-based rewards appear likely to survive in some form. Passive parking probably doesn't. The regulatory dividend is not a price prediction, it's a structural observation. When the alternatives to Bitcoin get regulated in ways that reduce their attractiveness, Bitcoin's comparative case gets stronger without Bitcoin itself changing at all. That's an unusual dynamic, and it deserves to be in your thinking if you're making long-term allocation decisions. And the decoupling thesis is the long game. The more every other digital asset accumulates regulatory complexity, the more Bitcoin's simplicity becomes something institutional capital is willing to pay a premium for. What needs to be true for all three to fully materialize? The yield squeeze has to become final law. Institutional capital sitting in yield-bearing stablecoin positions has to rotate, at least partially. The Clarity Act has to pass with Bitcoin's commodity status confirmed. And the macro environment needs to stabilize enough for risk appetite to return. None of those are guaranteed. All of them are in motion right now.